We are losing our early morning mojo as futures drop. 30 minutes till the cash trade. Welcome to a special edition of Open Interest live from Bloomberg Invest in downtown Manhattan. I'm Matt Miller.
I'm Katie Greifeld.
And I'm Sonali Basak. And we're gathered here again in the heart of New York's financial district. We've got executives, deal makers, investors from across the globe. And it's fascinating because where we were yesterday, guys, is a little different than where we were today, though we are headed lower, it looks like, once again, to start the day on different reasons.
Yeah, absolutely. The situation is fluid, both when it comes to the tariff picture, the economy, and these economic and financial markets as well.
I'm very focused also on what's going on in Europe. The Germans have agreed to spend an extra $500 billion, which for Germans is a ton of money and normally would break a lot of rules. And you know Germans hate breaking the rules, but they're going to do it anyway.
But it brings up that U.S. versus the rest of the world story that everyone is keeping an eye on.
Yeah, absolutely. I mean, the rest of the world tariff story is also a big focus for these markets. That's why we were rallying early this morning. Howard Lutnick on Bloomberg Television saying that by this afternoon, we should have some relief from Mexico and Canada.
And I'm eager to get to those markets, so let's go through this guest lineup because it's a big day.
Yeah, we're going to come up and speak with Tom Wagner of Knighthead Capital, Digitalbridge CEO Marc Ganzi, Shake Shack CFO Katie Fogertey, plus an interview with David Rubenstein, sitting down with former Treasury Secretary Steve Mnuchin in the next hour. And boy, am I curious to see what he thinks about what's going on.
Yeah, big time, especially after hearing from Bob Rubin yesterday, one of the highlights of yesterday's panels. Let's get to these markets because, boy, there is a lot of action. You wouldn't necessarily know it by looking at the S&P 500 unchanged in futures, which we will show, I hope. We were looking at a rally, but now that has dissolved into downside. We did hear from Howard Lutnick on Bloomberg Surveillance talking about maybe we'll get some adjustments on tariffs this afternoon. But what's driving this market, it seems to be, is that data that we got at 8:15 for February, ADP employment rather, that change coming in at 77,000 jobs. That is versus expectations of 140,000 jobs. We know that the line is fuzzy at best when it comes to ADP and NFP coming up on Friday, but at least for right now, it seems to be driving some of those growth fears that we've been worried about. You can see the two-year Treasury yield reflecting that, down about 9 basis points.
Check out what's going on in Germany. We don't normally show you the European indexes, but the DAX is just stunning. A gain of more than 3%. And the DAX, by the way, is up 20% year to date. So handily outperforming the S&P 500.
European exceptionalism.
Yeah, really interesting for an economy that is broken. But after that announcement, obviously investors are piling in, and you can bet that they were guessing this was going to happen. The German 10-year yield up 22 basis points. That's got to be up there with the biggest gains we've ever seen in the Bund, right now trading at 271.5.
Going to come back to the U.S. Some stocks we're watching over here pre-market. Chip makers like Micron climbing after hints that the White House may ease tariffs against Canada and Mexico soon. We're going to talk about that more in just a minute. And Abercrombie & Fitch struggling to meet lofty expectations for the year despite sales steadily rising in recent years. This was kind of an NVIDIA level stock the way it used to be rising. Expectations now higher. Consumers may be weaker. We'll keep an eye on consumer stocks more largely. General Motors up 5%. Car makers just like them are all moving higher. Commerce Secretary Howard Lutnick has teased relief for the sector in an announcement expected this afternoon.
Well, let's hear a little bit of what he had to say. U.S. Commerce Secretary Howard Lutnick on surveillance earlier this morning. Let's take a listen.
The president is listening to the offers from Mexico and Canada. He's thinking about trying to do something in the middle. He's thinking about it. We're talking about it. When I leave here, I'm going to go talk about it with him. And I think early this afternoon, we expect to make an announcement. And my thinking is it's going to be somewhere in the middle.
For more on that, we're joined by Anne-Marie Horder, Bloomberg's chief political correspondent, also co-host of Surveillance. Anne-Marie, this is fascinating because these tariffs went on yesterday. And so by this afternoon, we expect some relief. Isn't that a little bit too much volatility for business leaders?
Well, potentially. The administration doesn't really see it like that, of course, because it looks like the president is in negotiating mode and he's getting concessions out of Canada and Mexico. up until this moment, really. When you speak to the Commerce Secretary, Howard Lutnick, he says he's been on the calls with these officials. What we've seen Canada do in terms of the border, fentanyls are, we've seen Mexico do, as well as potentially Mexico might be weighing whether they might put the kind of levels of the tariffs the United States has on China. They may do that as well. They're extraditing 29 individuals that are criminals with the cartel. So they're seeing a lot of progress, and potentially we could see relief for companies today. And I think the Commerce Secretary made it pretty clear, if you are USMCA compliant as a company, you might get relief today. And then, of course, I asked him, are the big three automakers, which the president in his joint address to Congress said he spoke to yesterday? He said he spoke to those executives. Are those companies USMCA compliant? He says he does believe so. And that is why you saw a little bit of a relief in some of these car makers, because it looks like today they will get some relief, potentially some exemption or some sort of carve out or a lower tariff rate.
And yeah, you can definitely see that relief in shares of GM. Anne-Marie, we do have some breaking news right now, and that is that the Supreme Court has rejected Trump's U.S. foreign aid freeze. Just talk us through that. I don't know if that necessarily came up with Lutnick, but obviously that has been one of the biggest stories to follow this week.
It did not come up with the Commerce Secretary. That is really out of his purview. This would be more of a conversation with the Secretary of State, Rubio. Clearly, what we've seen the president do when it comes to U.S. aid and wanting to put those funds on a freeze, a lot of things the president is doing when it comes to DOGE and basically the firing of federal workers, all of this is going to play out in the courts. One thing that did come up with the Commerce Secretary is the April 2nd reciprocal tariffs. And we asked him if those tariffs are going to be put in place on April 2nd, or is April 2nd basically going to be the starting gun? Because I can tell you, when it comes to the legality of how to enact tariffs, it takes months. So potentially, if they enact some tariffs and they don't have enough time frames in terms of legal framework, even tariffs and trade policy could end up in the courts as well.
Anne-Marie, thank you so very much for your time. That is Anne-Marie Hordern in Washington. Great interview, of course, with the Commerce Secretary. And joining us now, Knighthead Capital Management co-founder Tom Wagner to answer all these questions around tariffs, DOGE. You know, investors are trying to shake off some of these worries when it comes to tariffs. But really what you had Howard Lutnick do is set a new target on April. How much more uncertainty does this cause? And how do you think through the risks here, particularly from an investment point of view?
Yeah, well, first of all, thank you for having me. I think the important issue to remember when you're analyzing how these negotiations are proceeding is first and foremost to remember that they're negotiations. And the second is to think about the timeline of your investment. If you're a trader, there's a lot going on, there's a lot of uncertainty, there's a lot of back and forth. If you're an investor and you have a long-term perspective, I think we all have a general idea as to how things will end up. And then the question is, what is the cost to your individual investment or the economy as a whole between the start of the negotiations and the conclusion of those negotiations? I don't happen to believe that the timeline will be very long, and therefore I don't believe that the cost will be very high. And ultimately, you have to answer whether or not you believe that the final benefit is worth that cost in the interim.
It does seem like the president is getting a lot in these negotiations. I mean, if you look at what he's done with Ukraine, right, he's trying to get the Europeans to spend more, and now the Germans have announced they're going to spend $500 billion on defense. This is what he was aiming for.
Yeah, I think that's exactly what he was aiming for. I think the other thing that upset the president a little bit in Ukraine was the relative priority of repayment of the debt or the funding that had gone to Ukraine during the war, where the U.S. had taken a subordinate position, yet a leadership role in that funding. And I think that was a fair complaint, quite honestly, particularly given the fact that for the Europeans it was more of an existential risk. So I think readjusting that by way of the minerals deal is a huge benefit to the U.S. and, quite honestly, a fair one, given the amounts that had been paid out over the last few years. It doesn't mean that we won't see support, that we won't see the end of the war. It just means that the mechanism by which we achieve that objective will be a little bit different than what was pursued by the last administration.
Well, let's talk also about tariffs and the potential impact here on the American economy. We were just discussing with Anne-Marie, because this is just something they discussed with Howard Lutnick, the idea that this injects a lot of uncertainty into, business plans, how businesses are planning their capex over the coming year or so. As an investor, thinking about this economy and what companies might potentially be opportunities for you, how are you viewing that landscape?
Well, I mean, selfishly, if these tariffs were going to exist for a long period of time, we'd have a very ripe investing environment because the dislocation that it would cause would be pretty extreme. However, I don't believe, given the incentives, that the tariff structures that are being discussed today will be in place for a long period of time, if at all. I think that, again, it's the negotiation process that causes the uncertainty, and I think that's more of a trader's dilemma than it is an investor's dilemma. And so as a result, what we're focused on is what's the end game likely to be? Will that create more opportunities? Will it create disruptions in the businesses in which we're invested? I don't believe that we're going to end up in a place where you have significant and permanent lasting disruption to the economy because the incentives for each side to get to a deal are too high. And whenever you're faced with uncertainty in a particular negotiation, the first thing you have to think about are the incentives for each party. And in this case, in any of these bilateral trade disputes, the incentives are really high to find a solution.
I want to just jump in and point out that Claudia Sheinbaum has said that if these tariffs continue, Mexico will reach out to Canada. So it looks like they may want to team up in opposition to President Trump's tariffs, although it looks like we're going to get some relief this afternoon. I want to ask Tom about the businesses that you own. Are any of them specifically affected by tariffs? Because I think of companies that you hold that are even household names, but they're not really cross-border transactional.
Yeah, it's interesting. In the context of our holding in Hertz, I think, a rise in tariffs against imports will result in higher used car prices. That's a net benefit, at least in the short run. Again, I just don't think that we're going to see, as much as that would be a tailwind, I don't think that's likely to transpire. And some of the other private companies that we own where they may have imports for components and parts to build their product, that would raise the cost.
Good point. Revology.
Revology, certainly. Singer would be another potentially. However, I think the way that we're looking at it is what's the impact on the economy? What does that do to the demand face? That's the more important element.
I really want to know your thoughts about this because the word recession is coming up more and more. But before that, I want to go back to what Matt was saying as well. It's not just Mexico and Canada looking at a way to pair up and figure out how to get together in the face of these tariffs with the U.S., it's also Europe, right? You're looking at Europe band together in this way for defense. What I'm wondering is, do you see a scenario, given the trade flows, that Europe gets even closer to China? What kind of problem does that create for the United States?
Well, I think that some of what's going on with respect to European-China trade is causing problems for Europe itself. The European automotive industry is being significantly disadvantaged because of the lack of tariffs on Chinese imports. That's their own internal disruption. So that closeness, it gets a double-edged sword. I think we have to look at these trade disputes and understand what the driving force is behind them. In the context of China, it's largely a fentanyl-related issue. In Mexico and in Canada, it's both fentanyl, drugs, and cross-border, movement of people, right? Those are the major issues. It's not solely the economics. And I think if we were to take a step back and focus solely on the fentanyl issue for a second, if I told you that there were terrorists crossing our borders and that resulted in 2 deaths of innocent Americans per day, you would say, by God, we have to do everything possible to stop that. There would be a national uproar against it, particularly if it was totally randomized. What's happening in reality is we're losing 200 lives a day, 250,000 since 2018 of deaths to fentanyl, right? They happen to be concentrated in some of our poorest communities, so they may not always make headlines, but that's an extraordinary loss of life, vastly higher than we've suffered in human loss in all of our conflicts for the last 60 years. So when you take a step back and you look at it through that lens, I think we have to say, well, what is the greater good? Is the pursuit of some of these policies, while we may not like the negotiating style, is the pursuit of the policies for the greater good and putting an end to something that has caused so much pain. For 250,000 mothers out there, these policies are the best thing that have ever happened. And so I think it's important to understand where you're coming from and what the driving force is, in addition to what the economic impacts are.
Right. Well, Tom, to your comments on fentanyl, also from Commerce Secretary Lutnick's interview with Bloomberg TV, he said that this is not a trade war specifically with Canada and Mexico. It's a drug war. Of course, there's a lot of questions about how much fentanyl is actually coming across our northern border, but that's a different discussion. I want to go back to the U.S. economy and what you were saying about tariffs and the disruption that they might create, potential recession some folks are calling for at this point. you said that as a long-term investor, that would be an opportunity for you. And to that point, I'm wondering, do you have any dry powder at this moment that you're looking to deploy?
Yeah, there's always, you can shift the portfolio around. We don't run levered portfolios, so there's always an opportunity. We also are fortunate enough to see a lot of inflows on a monthly basis. So, if it takes 6 or 9 months to hit a recession, we'll have plenty of capital to deploy. I've also found that post the global financial crisis, there's always capital available. So if the opportunities present themselves, you'll be able to find the capital. And in the depths of COVID was when we raised our travel and leisure focused fund with Certares Asset Management. Didn't have a problem finding capital. Yeah, that was an intentional raise, and it worked quite well. So I think if we run into an opportunity set like that, the capital will be available in addition to what we have internally. So it's difficult to plan for recessions because they sort of happen because people don't expect them, not because it's on the horizon that you say, okay, these tariffs are going to cause a major dislocation. I think if the tariffs were starting to cause a major dislocation, it would be bilateral, and the incentives would go even higher. So the pathway to finding a deal becomes even clearer. The prospect of a recession probably leads to an outcome that helps us avoid one.
All right, Tom, let's put a pin in this discussion. So much to get into. You're sticking with us. That is Tom Wagner. He'll be joining us next block as well. But let's get a quick check on futures here. A busy market underneath the hood. But you take a look at the benchmark level right now. We're actually a little bit higher. Of course, we erased our gains after we got that ADP print at 8:15. Now you can see we're a little bit higher, a little bit more if you take a look at the NASDAQ 100 and big tech up about 0.3%. The small caps hang on as well. Much more coming up. This is Bloomberg.
All right, we are back here at the Bloomberg Invest Conference. We have a killer lineup again for you today. Sonali Basak has done a great job organizing this conference, and we're really looking forward to Steve Mnuchin at the top of the next hour. We're still with Tom Wagner, the co-founder of Knighthead Capital, and Tom, you're invested in some of my very favorite businesses, and I would say also there are a lot of Bloomberg viewers who lust over the automobiles created by Singer and by Revology, and who follow, the sports teams that you back as well, from soccer to Le Mans racing. But talk to me first about the car business, because as you said, it's one of the few that could really be affected by tariffs. When Revology is building these Mustangs, they need the motors, they need the transmissions, and they need steel, which is looking at tariffs on March 14th.
Yeah, I think that, in the context of these cars, you have to take a step back and recognize the demand is vastly in excess of the available supply. That was one of the key components of our getting involved. And what's driving that is our view, as the world digitizes and electrifies in vehicles, you see an increase in interest in cars that inspire some level of passion. We've talked about this kind of thing in the past. And that's resulted in people really falling in love with the restoration of old Mustangs or old Porsches. And the reason is the experience is so analog and visceral, right? You get into a car, it feels different, it smells different, it drives different. It's likely a vehicle that you fell in love with as a kid and then ultimately lusted after as an adult. And I think that, we look at that, we see a very rosy outlook for the forward demand of these things. And I think we're all in on being, forever involved in those situations. So, that's how we look at the demand phase for those products. And I think it's less of a tariff issue and more of what's the quality of the product that you can deliver. And that's beyond simply what you're constructing, and it goes into, the overall feeling of what you're providing to the consumer.
As a car guy, people always play this game, like if you could have 3 cars, if you could have your perfect
car garage,
what would be in it? And I always include a Singer in there because they're such special vehicles. I mean, they're really like works of art. I would rather have that than a Rothko, for example.
Right.
But they're, $1.5, $2 million to get into, so I'm still saving up. But is the market still there? I mean, on the high end, in the luxury market, is the demand still strong in this economy?
For sure. It absolutely is. And I think the same is true for Revology, which is a slightly lower price point in the $200,000 to $400,000 range, depending on how you option the vehicle.
Mine would be 4.
And yeah, exactly. But the reason for that is these become lifetime purchases, right? And my brother was talking with me yesterday about the idea of a dead man car, which is a great Jerry Seinfeld quote. You know, you buy the car from a guy that is dead and you won't sell it until you're dead. They're things you intend to own your whole life. And I think cars from Revolution and Singer fit that bill perfectly. These are things that folks really want to have and hold and experience for their whole life.
Okay, I get the mic now. We're off of cars. We're on to my love.
We can continue showing video of Singer though. If you want.
Or Tom Brady and the Raiders, which is where I want to go next. Okay, so I'm a reporter of the people. When Tom Brady took a stake alongside you and others for the Raiders, one question I had, it's interesting to see a former player get a stake. Do you see a scenario in which you have players asking for equity?
Yeah, that is not going to happen in the NFL. Specifically because it's not allowed, at least under current rules. And I think that the reason for that is it really begins to complicate the salary cap issue. And so for the integrity of the game, I think the commissioner, Roger Goodell, and the owners have done a very good job in helping to ensure that pay is pay, and it's quantified under very, very clear terms. When you start offering equity, there's a question around valuation, there's a question around terms and control. And so I think that upholding the sanctity of the game is a really important component of it. What makes Tom's involvement so special is that he had the wherewithal to buy a meaningful piece of the team because he's been highly successful and he's done a good job of building up a substantial net worth. The more important element is that Tom is very involved, right, and will provide his insight into best practices. And I think that's a really enormous value add. We've certainly seen that firsthand in Birmingham City in what he's been able to do. And I think the Raiders have the benefit of additionally having folks like Egon and Mike Meldman involved who will really drive the excellence on the business side. So it's a multifaceted story in the Raiders, and I'm super excited just to be around those people because they have so much to offer.
It's so interesting, Katie. I was talking to Rob Gronkowski soon after that deal was done, and it was such an inspiration. You have now more and more former players wanting to pull another Tom Brady is what's been going on.
But not with the money that Tom Brady has.
Well, or the partners, right?
Yeah.
There you go. So football is just one of the sports that's in your sports investing portfolio. So I want to talk to you as an investor in this space. I can't imagine that you're bringing your distressed investing playbook to the sports world. So how do you evaluate potential investments that you might make? What factors are you actually looking at there?
In every case in sport investing, at least as it relates to how we look at that sector, is a question of whether or not we can drive an increase in commercial revenues, right? The aggregate revenue of the franchise or team or club needs to be increased. And when we looked at the assets that we've made and the purchase we made, that was the key focus. Birmingham City, it was all about can we grow commercial revenue? And the reason in Birmingham City that was important is that when you look at the teams that are going from the championship into the Prem, the top 8 teams on average are receiving payments from the Premier League in parachute payments to make up for them having been relegated. There's 16 other teams that don't receive parachute payments. The teams that have that additional revenue are 4 times more likely to get promoted to the Prem. And so you have to cross the £50 million mark in total revenues to fall into that zone where you can say, okay, now I'm on equal footing from a revenue perspective. So when we bought the club, we were doing just over £19 million in turnover.
Right.
To next year on a projected basis, if we're lucky enough to get back into the championship, we'll do north of £50 million. And that's a huge adjustment in a very short period of time that makes us highly competitive. So that was an example of where we've been able to do it. If I flip it and look at in racing, where we just got involved in Legacy Motor Club with Jimmy Johnson, that was another one where we had a really strong view on Jimmy's commercial attractiveness and what we could do with the team and our view of what would happen with NASCAR in sort of a changing environment, cultural environment in the U.S.
Right.
And we have a strong view that we'll see a significant increase in commercial revenue there as well.
All right, Tom, we have to take a commercial break. Pleased to say that you're joining us when we get back. We'll take you through the market open next. And it looks like futures back in the red when it comes to the S&P 500. It's been a volatile morning. We're just about unchanged. They had to do me dirty there, but tech holding on to its move, as is the bond market. The open is up next. This is Bloomberg.
All right, we are moments away from the start of trading. This is a special edition of Open Interest. We are doing it live from Sonali's Bloomberg Invest conference down here in Lower Manhattan. I'm Matt Miller alongside Katie Greifeld. And Sonali Basak. We've seen futures swinging back and forth between gains and losses. They were firmly solid this morning when Howard Lutnick went on at least a couple of business news networks and said, we're thinking about giving Mexico and Canada some tariff relief 24 hours after putting tariffs on them. But then they fell after we got the ADP numbers. Of course, we're waiting for that all-important non-farm payrolls read on Friday, very key to the Fed. And I guess really that was enough to outweigh the tariff relief concerns, at least for a moment. We'll see what happens throughout the day. We have the bonds back at 420. You've got big gains in European stocks and big gains in European yields as well. But look at this, Katie, not a lot of actual action.
No, but it's misleading, right? Because we know there's been a lot of volatility this morning, and we're coming off of 2 straight days of pretty heavy-duty losses when it comes to the S&P 500, when it comes to the NASDAQ 100 and the Russell as well. So at least for right now, a little bit of a sigh of relief. Small moves overall. We know a lot can happen between now and 4 p.m., so we'll keep an eye on this market. But let's take a look under the hood, because that's where the action is. We're taking a look at car makers, including GM, moving higher this morning after Commerce Secretary Howard Lutnick teased some relief for the sector. An announcement might come this afternoon. You can see these stocks rising in anticipation. Stellantis leading the way, up over 6%, Sonali.
I'm looking at Foot Locker, Katie, because it anticipates a tough first half of the year due to budget-conscious shoppers. Abercrombie & Fitch announced a $1.3 billion buyback. And so you do see the stocks diverging here, 12% up on Foot Locker, 12% down on Abercrombie. The growth was not enough to excite Wall Street. Remember, this was a stock on a tear last year. There are generally concerns about the consumer. It's interesting to see how investors are navigating it, Matt.
Yeah, absolutely. Usually when you buy back more than $1 billion of your stock, you see a green arrow there. So this is a big decimation for Abercrombie stock. Taking a look at chip stocks after Lutnick signaled there may be tariff relief following talks with Canada and Mexico. I still think it's so strange to see them in the green. I was looking at Intel. They were also trading positive in the pre-market after Donald Trump yesterday gave his State of the Nation, non-State of the Nation speech to the joint session of Congress. He said, essentially, we're not going to give them any more money from the CHIPS Act.
Exactly. He said that essentially he would like to do away with the CHIPS Act. We know that's funneled billions and billions of dollars to Intel. So
about $50 billion to the industry, but it's brought in $400 billion in investment. So
yeah, a lot of moving pieces here, but I don't know. You can see Micron trying to decide what to do. Let's broaden out, though, and get back to Knighthead Capital's Tom Wagner. I'm pleased to say he's still with us, and we're going to get back to sports. Just a fair warning there. But there's an interesting note out from JP Morgan this morning showing that market-implied probabilities of an economic downturn has climbed to about 31%. We were talking about this about a half an hour ago, basically, that you will have capital available should opportunities arise. And I'm just wondering what sectors, what industries you're keeping an eye on right now.
I think the one that we're the biggest chunk of our capital is flowing right now is in the market to serve the data center and AI community. We're developing a large project in Pennsylvania that will take what was a coal-fired power plant and decommission that, which has already been done. It will tear it down and build new generation to serve the data center community broadly defined, which a substantial component of, if not all of, will go for AI compute. And I think it's a great example of taking an asset that doesn't work in today's economy for a variety of reasons and transitioning it to something that is maybe the hottest sector in the market. And so we're excited about it. You know, we'll have a mix of generation fuels and capacity. We've got some really exciting forward-looking opportunities on the nuclear front, and so there's a lot that's happening there, generally speaking, and I think we're really thrilled, to be leading that.
Oh, you know that I get jazzed about data center math. I could go on about it, but I do want to ask instead about AI, the opportunity, what it's going to do to the economy. Is it more likely to create a huge dent in the job market, or more likely to amplify productivity to the point that you see real economic gains?
I mean, I've got some kind of kooky views on this, generally speaking. When we look at technological innovation, and we've seen an extraordinary amount of it in the last 100 years, it hasn't resulted in mass unemployment, right? In fact, we find ourselves at the point of highest technological innovation in human history, and we have in many economies a shortage of skilled workers. So I think that technology has a way of empowering workers and providing newer opportunities. To the extent that AI becomes extraordinarily disruptive, so long as we have an economy that is sort of working in the context of how it's worked over the last couple hundred years in a modern capitalist society, what we may do is create more free time for people. And we may move to 4-day work weeks. We may have more free time and see an economy that begins to transition.
You're getting my hopes up, by the way.
Yeah, well, if it transitions to one where there's more leisure activity, that's certainly good for some of the things that we talked about. It's good for Matt's pursuit of his passions in autos and motorcycles. But I also think that it's a positive for the overall human existence, right? As long as we have something that's fulfilling for a substantial component of the week so we can get satisfaction out of being productive, I think it's quite reasonable to expect that we have more free time. And that's really, if you talk to a lot of the futurists that are more optimistic on the deployment of AI, I think that's where they'll tend to, and I fall into that camp personally.
That would be more babies, right? That would change the demographics.
Babies, more robots.
With more free time, we could have more babies and go see. I could go see the Isle of Man TT.
Yes.
I could go see Le Mans.
Right.
The population
I
problem.
do want to get back just quickly to sports because it seems like you have such a great international view, at least in this sector, right? We were talking during the break about your we were talking in the last block about your investments in cricket and talking about the motorcycle racing, talking about Le Mans where you own Jota, and I know we have some fantastic footage of those cars. It's incredible. But how do you get this international view here? And do you invest in all of this stuff with Tom Brady? Is he always your sports betting partner?
I mean, we want Tom to be involved in all of our sports properties because he's so additive. He's definitely involved in our Le Mans team. He's got his name on the side of the car. You should, honestly, Le Mans is one of these great sporting events that is unknown to a lot of people in the U.S., or at least they're not enormously familiar with it beyond, say, Ford versus Ferrari and that wonderful movie that came out a few years ago. I would highly encourage you to do a show from Le Mans. It's one of the most attended sporting events in the world. It's this incredible 24-hour race. It's got extraordinary uncertainty of outcome. You have no idea who's going to win the race until the very end, and it's actually a really exciting time. So, it's a good excuse to be in France in the middle of June.
I'll do it.
I think our bosses might be listening.
Yeah, do a Thursday show during the practice sessions. It would be a lot of fun, and we'd be happy to host you. We've got a great facility with our partner Cadillac and Jota and Hertz, who are all heavily involved there. So, look, I think that our involvement in these assets are because we see an opportunity. In Le Mans racing, it was a very, very, very low entry point, but one where we believed that the excitement of the race was generally misunderstood in a lot of the global sport viewing community. And we thought that we could bring that market to people and help increase that attractiveness over time.
Tom, we got to leave it there. We thank you so much for joining us. Of course, crazy market out there. And of course, investors still looking for direction. That is Knighthead Capital's Tom Wagner. And let's hope his 4-day work week thing sticks, guys.
Let's all go to Le Mans. Let's do our show from there.
That's another great idea.
Yeah.
Lot to work with here.
Now, I'm heading out to go back to Invest Day 2. We are going to have Steve Mnuchin at the top of the next hour. But coming up next, Digitalbridge CEO Marc Ganzi is going to talk to this show about AI infrastructure opportunity in the United States. Get his view here, guys, on that data center map. I don't even believe it. Let's see what he has to say. This is Bloomberg.
All right, welcome back to a special edition of Open Interest live from Bloomberg Invest in downtown Manhattan. You take a look at stocks right now, actually catching a bit of a bid. The S&P 500 up by about 0.4%. The NASDAQ 100 not too far behind. Same story if you take a look at the Russell 2000. Of course, we're coming off of 2 straight days of a pretty brutal sell-off, so a bit of a bounce back right now as we count down to NFP, that jobs data coming on Friday. We had a pretty ugly reading of ADP private employment this morning, but the line fuzzy at best. Meanwhile, let's shift gears and talk about data centers, because Digitalbridge is helping build out the infrastructure needed to power artificial intelligence from data centers and cell towers to fiber networks and more. CEO Marc Ganzi joins us now on set. Great to see you in person.
Thanks, Katie. Good to be here.
So you were telling us before the segment started that you've been investing in this space since 2014. There's a lot of folks now involved who maybe didn't have it on the radar about a decade ago. So just tell us how the industry has changed, how the competitive landscape has changed as you're trying to identify opportunities?
Well, if you look back to the advent of public cloud back in 2011, there was probably in total less than 1 gigawatt of compute power powering data centers around the United States today. Contrast that to today, we're at about 18 gigawatts. And depending on whose prediction you believe, we're going somewhere between 130 gigawatts. Masa-san said 2 weeks ago at a conference, 300 gigawatts. Kind of hard to extrapolate who's going to be right and who's going to be wrong. I don't think we need to make that bet today. But what we do need to understand is that capacity is at least going to grow by 10x over the next decade. And that really confronts the industry with a lot of challenges.
Well, talk to us about the DeepSeek of it all, because you think back to DeepSeek Monday, and it really raised this existential question of whether this build-out, this AI build-out has been extravagant. Maybe it didn't need to be as robust as it has been. Would love to hear your thoughts.
Well, look, my thoughts is it's a history lesson, right? If you go back when we were building, I've been building infrastructure for 31 years. So I built mobile towers in 1994. I connected New York City with high-speed internet in 1998. And for me, this is just another tectonic shift, Katie, in technology. We started with the internet. We moved then to mobile data. We moved to public cloud, and now we're moving to AI. These are decade, generational investment ideas. These are not investment ideas that happen sort of quickly and overnight. Now think about as we adapted to the internet and we adapted to mobile phones and to public cloud. Guess what happened along that adaptation curve? Costs went down. And so what you're seeing with DeepSeek is that you don't need to build a large language model to be in the business of supplying AI and supplying generative AI. And I think DeepSeek was, for us, it was really a point on the inflection curve where we see costs coming down for developers and application writers. But ultimately, the infrastructure behind that, remember, was provided by Meta in terms of their open source code. And to build that LLM model for Meta took years and billions of dollars of capital that enabled DeepSeek to get where it is. Innovation is going to happen. Innovation happened in public cloud. Innovations happen in mobile data with respect to mobile networks. And so as you see adaptation move up on a J-curve, you see costs come down. This is really Jaron's paradox. And if we think about that in the context of framing 30 years of investment in digital infrastructure, DeepSeek for us is a logical progression, not something that we should be alarmed about. And in fact, since the announcement of DeepSeek, we've had 4 of our customers come back and say they're increasing CapEx. Meta, Apple, look at what Alibaba just said last week, $58 billion in new data center CapEx spent around the world. So our customers today, Katie, are spending more money on infrastructure, not less.
It's funny, first of all, I covered the 3G auctions as a young cub reporter. So I've been right there with you along the way. And in this current technological revolution, you see a lot more profit than you did back then. And you see a lot more immediate use cases than you did back then. But I was hearing about AI from you, I think, for the first time on a Microsoft Teams call, and you were telling me about how much power these things need. Regardless of the cost, we still need that power. How are you getting it for your data centers?
So I think power is really the long pole in the tent right now for data centers. And I think we've taken a very pragmatic approach, Matt, which is there's going to be situations where we're partnered up with the grid operators, which are traditionally the publicly traded utility companies. And there's going to be situations, Matt, where we go off-grid, where we're building our own solution set. So we started building microgrids about 2 years ago. We've done that in 2 locations, one in Reno, Nevada, and we built 2 microgrids, believe it or not, in, of all places, Tambor, Brazil, where we're operating 1.3 gigawatts of power, and it's all hydro. We own our own microgrid. We've leased our own transmission infrastructure. And when we couldn't get the right answer from the utility company about getting power, we took that problem in our own hands and we solved it. So I think part of this is you're going to have solutions that are on-grid solutions. You're going to need solutions that are off-grid solutions. And by the way, we need the full arsenal of power, Matt. You need coal fire, you need LNG, we need solar, we need wind, we need hydro. We need everything that we can throw at it because the amount of power that's coming is just massive.
By the way, Marc, everything looks full speed ahead, right? Your assets under management have quadrupled, quintupled in the last 5 years. Except for yesterday, the president said he wants to stop the CHIPS Act and slow down the money that's flowing out to these all-important semiconductor producers in the U.S. Does that make sense to you, and does that kind of throw a wrench in our plans?
Well, I don't think it throws a wrench in the plans. I think what the president is signaling is he wants to put America first. And I think he wants to bring manufacturing and jobs back here to this country. And look, whether you're on the red side or the blue side of the aisle, that's a purple issue. I think we all want more jobs and we all want
That's
more.
what the CHIPS Act was for, right?
It was,
that's,
yes.
That's the whole point of it.
And so we don't see a shortage in chips today. I do believe you got to look around corners and you got to think about what's coming next. We do see a shortage in GPUs over time. I think that is something that has to work itself out. But ultimately, the amount of capacity that's going into data centers today is well understood for the next 3 years. It's where do we get to, Matt, in 28, 29, and 30, and where are the next generation chips going to come from? Are they going to be built here? Are they going to be built in Asia? Where are they going to be built? My bet is some of them are going to be built here, but don't sleep on Asia. Asia will build a lot of GPUs and a lot of chips. Look at what ARM's doing and the ambition that Masa has.
Right.
Those chips won't be built in the US. Some will be built in the US. Some will be built in Japan. So I think you have to take the long view on semiconductors. You have to take the long view on chips. And I personally am long-term on GPUs and chips.
All right, Marc, unfortunately, we have to leave it there. Hope to continue this conversation
Anytime.
soon. Really interesting. That is Digitalbridge CEO Marc Ganzi. Meanwhile, let's get a check on these markets. We're about 19 minutes into the U.S. trading day. You can see the S&P 500 still kind of deciding what to do. Currently higher by about 0.1%. We know that we've seen a lot of pain over the past 2 days, a lot of questions around the will he, won't he. Okay, he did when it comes to tariffs, but maybe they'll roll back a bit. All of that volatility coming through in these equity markets. Similar story in the NASDAQ 100, now down about 0.1%. The small caps actually holding in here. The Russell 2000 up about 0.2%. I want to quickly look at the bond market, though, because you saw that ADP figure come in very light this morning for the month of February, and we're awaiting to see what we get in the U.S. jobs report on Friday. Hopefully we'll show the 2-year yield, but you take a look at the
There
curve.
you go.
There
Prayers
we go.
answered, Katie.
I actually got the 2-year yield. I also have the 10 and the 30-year yield, and you can see the curve. A lot of the buying coming in at the short end. 2-year Treasury yields down about 8 basis points. Of course, we know that traders are now pricing in more cuts this year than they were just a couple of weeks ago. I believe it was 3 cuts priced in for 2025 last I checked, and you're seeing that expressed in the 2-year yield. The 10-year yield, not down as much when it comes to the actual yield, but still down about 5 basis points.
Can I just say,
here.
we
Yes,
saw,
you can.
I mean, speaking of yields, not necessarily American, we saw the bunds jump 25 basis
You're
points.
taking us to Germany.
Well, I just think it's a fascinating story, right? Germany has historically underspent in terms of defense, right? We haven't always wanted Germany to rebuild their military.
This is true. This
you know?
is true. So
and now they're rearming. Maybe problematically just as the far right starts to gain a huge amount of the vote. But nonetheless, they're going to spend $500 billion on defense. You see a 25 basis point jump in the bunds, and that's the biggest jump we've seen in those bonds since 1990 when reunification happened. So it's kind of a big deal.
Kind of a big deal. Big deal in the German bond market. Big deals happening in the U.S. bond market. Bob Rubin telling us that yields are going down for the wrong reason, Matt. There's a lot of concerns about the economy and also the consumer.
Yeah, absolutely. I want to, how do I make this shift?
I did it for you.
The consumer.
Yes.
The consumer. I got it. Okay, let's focus in on the consumer. Not necessarily borrowing money to go to Shake Shack, although I do love those smoke shacks, the double. CFO Katie Fogertey is here with us on set at the Bloomberg Invest conference. Katie, great to see you again.
Great to be here.
I did a special edition of Chief Future Officer with Katie, which was amazing. That's the first time I tried the smoke shack, and now I'm addicted. You don't need anyone to take out a loan. Nonetheless, the consumer health, I guess, is key to your business. How's it look from your position?
We reported an exceptional fourth quarter, and it really has been a story that we have been executing against, a strategy that we've been executing against for many years now, of leaning into our strategies around marketing, driving sales through culinary innovation, and improving our operations to continue to drive a better guest experience. And that really, our approach to the fine casual sector has really helped us to navigate what others are seeing in the consumer backdrop. So, we talked about this a couple weeks ago, but, the first quarter has started off a little bit shaky for a lot of other restaurant competitors. What we saw in January was exceptionally strong at 4% comp, just being able to navigate here against the challenges that others are seeing.
Katie, I'm a little bit obsessed with the bird flu, a little bit worried about it as well. Your CEO recently said that the egg shortage that we're seeing as a result of the avian flu is spurring demand, could spur demand for chicken and beef. I understand that Shake Shack is less exposed to egg prices because you don't offer breakfast, but walk me through the tie-in here. When it comes to beef prices rising more quickly than chicken prices, that surprised me a little bit. You would think that chicken would also be, actual chicken meat would also be sort of in a short demand right now.
There's a lot of interesting cross currents that are happening in the commodity market right now. Chicken has a little bit of has a much shorter growth cycle than beef does. And some of the pressures that, we and the rest of the industry are seeing on the beef side, those are just going to take longer to navigate, just given the growth cycle for the herd versus chickens. But we're really, fortunate that we have the supply chain team that we have in place and that we're able to navigate these challenges, to the best of our ability.
I'm really curious about your supply chain. And when you have shocks like this, I mean, there's some, as you mentioned, idiosyncrasies going on when it comes to cattle, obviously chicken, the nation's chicken supply in a funky place with the bird flu. Can you hedge it all when you're buying beef, when you're buying chicken? What does that look like on your end?
Sure. So a lot of different restaurant companies approach this in different ways. We use a very specific product for our ingredients. We, being in the fine casual sector, we use elevated premium, kind of the stuff that traditional fast food does not use. That includes no hormone, no antibiotic chicken. Our beef is premium, all Angus. And so that means that we can't really go to the open market and kind of hedge the things like our traditional peers will do. That doesn't mean that we don't have strategies to help navigate the cost, but when we have elevated inflation in various parts of the supply chain, for the most part on beef, we just don't hedge that given the very premium product that we source.
Katie, are you concerned about tariffs? President Trump tweeted about reciprocal tariffs maybe helping out U.S. farmers in the longer run, but we know that a lot of our beef, a lot of our produce here is imported, and those companies may face tariffs as well.
So we're watching this just like everybody else is. We are very fortunate to be in the situation where we source all of our beef domestically. And a lot of our supply chain, not just on the beef side, and also our restaurant equipment, are things that we make in the USA. So, that does insulate us from a lot of this noise. But at the same time, our supply chain team, we just celebrated our 20th anniversary of being a company, our 10th anniversary of being a public company. And we have built very deep relationships with our suppliers. And, it's just very critical in this moment to have that network to help navigate through all of these changes.
All right, very cool to see you again. Thanks so much for joining us. Katie Fogertey there. She's the Chief Financial Officer over at Shake Shack. I recommend going back and watching our episode of Chief
I will.
Future
I
Officer.
was just thinking I need to go watch that.
And then maybe we go to Shake Shack for lunch.
Right.
Coming up next, former Treasury Secretary Steve Mnuchin is going to join us. Well, he's going to be sitting down actually with David Rubenstein here at the Bloomberg Invest Conference. Very fascinating to hear what he has to say. Could be a little different than what we heard from Bob Rubin yesterday.
Yeah, really looking forward to that conversation coming up next on this program. Don't go anywhere. This is Bloomberg.
We're 30 minutes into the trading day. Welcome back to Open Interest. We are live here in downtown Manhattan at Bloomberg Invest, an amazing conference with a ton of great guests. I'm Matt Miller.
I'm Katie Greifeld, and boy, we have just been blessed with a great lineup, and a great lineup to talk about what's going on in these markets, in this economy right now. You can see actually the S&P 500 just about unchanged, but wiggling around because we do have some data in the form of ISM services for February coming in a little bit higher than expectations. 53.5, the expectation had been for 52.5, and that's higher than the previous reading of 52.8. So a little bit higher on the ISM Services headline. You take a look at prices paid. ISM Services prices paid. Here's where it gets interesting. Coming in at 62.6. That is above the prior read and the expected number, both at 60.4. Let's put together the pieces now, or rather, let's take a look at General Motors and some of the things moving under the surface.
Yeah, this is fascinating because we had Howard Lutnick on earlier this morning. He is the Commerce Secretary in this administration.
I've heard that.
And he has been saying both this morning and last night that we could get a reprieve on the Canada-Mexico tariffs. These have been roiling the automaker markets. Obviously, with Ford getting 25% of its U.S. production out of Canada and Mexico, General Motors getting more than 30% of its production out of U.S. and Mexico, and Stellantis getting more than 40% of its production out of the U.S. and Mexico. It is incredibly important. Jim Farley, CEO of Ford, has said these tariffs cause cost and chaos. And Lutnick is saying not only could we get relief from these tariffs 24 hours after they've been enacted, but we could also get relief specifically for the automakers on our air this morning.
Yeah, and he also said that all three big automakers are compliant. But to your point, I mean, Farley has also said the duration that these tariffs are on matters in terms of the cost impact. 24 hours, I don't know what kind of impact that has, but we'll continue to follow that story. But let's get back to the data that we got just a couple of minutes ago. ISM Services coming in hot on the headline, and also when it comes to prices paid. We'll turn to Bloomberg's Michael McKee for us right now. Put it together for us, Mike.
Well, this one should reverse the trade that we saw on Wall Street when the ISM manufacturing went down, because it is an unambiguously good report in the sense that not only did the headline services number go up and more than anticipated, but new orders rose as well to 52.2 from 51.3. So that is completely opposite from what we saw in the manufacturing report, where new orders just collapsed. Employment up as well. There had been concerns about overall employment in the services sector, and the ADP number today showed a weakness in services industry hiring. So we've got a disparity there. The prices paid, you mentioned, Katie, is higher a little bit, 62.6 from 60.4, but it's been above 60 for the last 3-4 months now. So it's not a major change, but it does suggest there are still price pressures out there. This is not likely going to be from tariffs, because A, the tariffs just got put on basically, and B, most of those are on goods. So it does look like we still have some inflation pressure for the Fed to work on.
All right, Mike, thanks very much. Bloomberg's Michael McKee talking to us about the economic news that is moving the markets today. We saw it this morning with the ADP, and now we're looking at a little bit of a bounce after those ISM numbers. I want to get right now to former Treasury Secretary Steve Mnuchin, sitting down with David Rubenstein here at the Invest Conference. Let's listen in.
I like the idea of the 10% tariff across the board. It's a consumption tax on foreign goods. But if he were to do that, he should do that through the reconciliation process, so that can be scored. I think would raise about $2.5 trillion and could be used to pay for tax cuts, as an example.
Speaking of tax cuts, you engineered with President Trump the very large tax cut of his first term. Do you think a similar sized tax cut is essential now?
Well, the biggest focus for them is just extending the personal side of the tax cuts, which are going to expire. And I think that, that was a signature part of his first term. And I think that's got to be the priority to continue. Now, on top of that, I know he wants to do additional tax cuts, and that'll be a little bit more challenging with the pay-fors.
During the campaign, he talked about a couple other tax cuts. One is no tax on tips. Are people getting tips actually paying a lot of taxes? I don't know. I mean, the cash they're getting today, I don't know how much they're paying, and maybe they're paying a lot of tax. Is that a big source of revenue or loss of revenue if you don't have tax on tips?
Well, we're not in as much as a cash society as we used to, so there's a lot of tips that go through an electronic mechanism. I think if he wants to have a small carve-out for tax on tips, I think that makes sense. I think, obviously, if you start giving tips to investment bankers at the end of the year instead of bonuses, and they don't get taxed, that would be a little bit more problematic. And you could tax your lawyers, so I think if he does that, it needs to have a small carve out.
In the campaign, he also talked about, I think, no tax on Social Security. Wouldn't that be pretty expensive?
Very expensive.
and no tax on overtime, too, I think he talked about. Does that be expensive, too?
It would be.
Okay, so when you were working on the tax cut, when you were Secretary of Treasury, how did you find the intellectual level of the Ways and Means Committee members? Were they really able to understand everything you guys wanted to do? And how was it like to engage with the Ways and Means Committee?
Well, I mean, there's no question, when we passed the tax cuts, and this was a lot of work, we were very engaged with both the House and Senate. And actually, we had weekly meetings, which was called the Big Six. It was me and Gary Cohn from the White House. It was the Senate, and it was the House. And literally every week we sat down and went through details. So, I mean, as you know, we had sweeping tax reform across everything. This time it is actually a lot simpler. But I do think Secretary Bessent needs to be very focused on working with the House and the Senate to get this across the finish line.
Okay, so in recent decades, the annual deficit has been fairly high. I think under President Trump's first 4 years, I don't know exactly, I think it was maybe $6 to $8 trillion of additional debt added to the total debt. We have that $36 trillion now. How are we going to get the debt down and the deficit down if we have these big tax cuts?
Well, David, let me just say, I think the deficit is probably the most important issue today in terms of the long-term impact on the economy. And just to put this in perspective, in the first term, we had debt to GDP ratio of about 100%. And with the tax cuts and economic growth before COVID, we were growing the economy faster than we were growing the debt. So that ratio would have come down. And I think we were trying to get it down to 90 to 95. The big focus on the first term was military spending. We unfortunately had to increase non-military spending to get it through the House and Senate. But what really impacted us was COVID. And I think, as you know, firsthand, we had to spend a lot of money in COVID or we would have had a worldwide depression, not recession. I think the problem was, the first $2 trillion was well spent. The next $2 trillion we never should have spent. And then the Biden administration kept on spending. So, we have debt to GDP of close to 125% today. That's a gigantic problem. Secretary Bessent has talked about getting the deficit down from 6% to 3% of GDP. And that's got to be a major focus. So if we're going to do the tax cuts, we need to make sure there's pay-fors, and we need to make sure there's economic growth.
When Bob Rubin was Secretary of the Treasury, he once talked about the value of the dollar, and he made a mistake, he later would say, by talking about saying something other than we want a strong dollar. And now every Treasury Secretary is told you can only say one thing about the dollar. We want a strong dollar. But what can former Secretaries of Treasury say about that? Can they say we want a strong dollar? Or can you say maybe it should weaken a little bit and to make our exports easier to sell?
Well, it's funny that you say that. And Bob really was kind of credited with the strong dollar policy. And I think it's kind of every Treasury Secretary after that kind of, you got Treasury 101 training. And the first thing they told you was just talk about a strong dollar. Actually, when I was at Davos, I made a comment that I commented on a balanced, stable dollar as opposed to saying a strong dollar. And all of a sudden, the dollar moved significantly. Look, I think, and now I can talk a little bit more freely about this, but I think on the long term, it is important that we have a strong dollar. The dollar is the reserve currency of the world, and a strong dollar reflects a strong economy. Right. In the short term, particularly because of trade, the strength of the dollar can have a negative impact. But I think the most important thing is actually a stable dollar so that there's not volatility.
Speaking of stable, what do you think about the Secretary of Treasury or the U.S. government supporting cryptocurrencies? They didn't really have them so much when you were Secretary of Treasury, but now cryptocurrencies seem to be very heavily supported by President Trump and his administration. Do you have any comment on whether that's a good or bad thing?
Look, my view on crypto has been pretty consistent. We did a lot of work on this in the first term. If people want to buy crypto as an asset class, like they buy gold, that's fine. I personally wouldn't invest in it, but that's fine. To me, the bigger issue has been making sure that crypto is not used for illicit activities. And, we spent a long time getting rid of Swiss numbered banking accounts, making sure that we have a mechanism that crypto can be compliant with BSA and all of our money laundering regulations. And I have concerns today about that.
In the business world, investment world, if you hire more fundraisers, you usually raise more money. In the IRS world, if you get more agents, you usually raise more money. But for some reason, the Republican Party seems to want to have fewer agents, and therefore they reduce the number of agents, and therefore maybe they're not going to raise as much money. Do you have a view on whether cutting back the IRS agents that were put in under President Biden is a good thing to do or not?
Well, I have a strong view on this. I spent a lot of time overseeing the IRS. I mean, the reason why Biden administration added so many agents, this is the silly part of government math. So if they added all these agents, they were able to score it that they were going to able to raise revenue in the future, and they spent that revenue today. So I actually don't think we need more agents. What we need is a bigger investment in technology in the IRS. The systems are outdated. And I think in this day and age, there's a lot we can do with technology that we don't need physical agents auditing people. It can be done electronically.
Now, is it possible for the Doge people to get the individual tax returns of a particular person who they might not like, or that's pretty impossible to do?
Well, it's not allowed. So people are not allowed to get individual taxpayer information. My understanding is that they can get access to anonymized information. Again, I think it would be helpful for Doge to help look at modernizing the technology, but obviously, looking at specific taxpayer information should not be allowed and isn't allowed.
Okay. Now, President Trump and his administration are very focused on the trade deficit, which is very, very high these days. But is the trade deficit that big a problem compared to the budget deficit? If you were to worry about which deficit, wouldn't budget deficit be more important than the trade deficit?
Well, as you said, we have what's called the twin deficits. Right. In my opinion, the budget deficit at $2 trillion annually is a much bigger problem. And I think, by the way, if you brought down the budget deficit, by definition, you'd bring down the trade deficit because you'd have less demand for goods in general. And I do think the idea of resetting trade relationships, I mean, President Trump is right that the U.S. market has been open for foreign trade, and foreign markets have not been open in the same way. We spent a lot of time with China on the phase 1 deal. They haven't lived up to that. But the whole idea was, if we could allow access, our business, to a growing China middle class, that's an enormous opportunity for U.S. business. And I do think kind of a big part of the trade deficit is we don't have fair trade in both directions.
Now, President Trump has made a big push on getting American companies and foreign companies to invest in the United States, manufacture things. That would probably be somewhat inflationary because, by definition, if you have people producing things overseas, probably because it's the lowest cost producer, if you bring them back to the United States with higher labor costs, it'll be a higher cost production, and therefore maybe more inflationary. Despite that, you think it's a good idea to have more things manufactured in the United States?
Well, I definitely think U.S. manufacturing jobs has always been a big focus of his. I think, there was a large part of the economy that was left behind. And I do think that's a focus. Now, obviously, there are different markets that can be competitive. So I think we can have the same thing. But his focus should be U.S. investment.
So when you became the Secretary of the Treasury, there was somebody on the Federal Reserve Board who had been appointed by President Obama, James J. Powell, who used to work at my firm. And then you recommended him to President Trump, I think, to be the chairman of the Federal Reserve. President Trump was not happy with him at the beginning, I guess, but I think he's going to keep him now, I guess. Any regrets about recommending Jay Powell, and how kind of job do you think he's done?
Well, let me first say, despite the fact that Obama did appoint him, Jay was a Republican and is a Republican. I had the opportunity to work with him really on a lot of the regulatory issues at first when Janet Yellen was chair. And I do think Jay's done a very good job. As President Trump, he had a bunch of issues with him raising rates. But then during COVID, he did give him the Most Improved Player Award when he dropped rates down to 0 at the time.
So generally, the President of the United States is not supposed to talk to or lobby the chairman of the Fed, but the Secretary of Treasury usually meets regularly with the chairman of the Fed to kind of talk about things to some extent. Did you meet with him fairly regularly, and how did those conversations go when you met with Jay Powell?
I did. I mean, we inherited a tradition which has been kept up, is that the Secretary of the Treasury and the chairman of the Fed meet weekly. It alternates every week between being at the Treasury and the Fed. And I found those meetings very helpful. I mean, a big focus was obviously what we were doing on regulation. Monetary policy. I never talked about monetary policy publicly. But yes, of course, we did talk about those types of things. We talked about the economy, and I think we had a very good working relationship.
So today, if you were Jay Powell, would you lower interest rates in the next 6 months or so?
I think it's pretty clear the Fed is going to lower rates. So, I mean, if you look at the dot plot, which is, what the Fed governors have publicly said, you do see rates coming down to about 3.25, and you see the long-term rate at about 2.8. I do think the long-term rate between being closer to 2.5 than 3, and I think we're going to see rates lowered next year. And by the way, I think the 10-year has that already built in to the market. So I think we're going to see 3.25, 3.5% funds, and I think we'll see about 4% 10-year treasuries.
So if President Trump were to call you and say, I need to have a new chairman of the Fed in May of 26, who would you recommend?
Well, I have a bunch of ideas, but I'm not going to say that publicly. I would say that privately to him.
Okay. So let's go to the next subject then. More important than the policy of the economic policy of the United States government is a subject called private equity. So you left Secretary of Treasury and you started a private equity firm, Liberty Strategic Capital. So is private equity as fulfilling as you thought? I know you were in it a bit before you became Secretary of Treasury, but how do you enjoy the private equity world?
Well, David, I've been in the investment business and the markets businesses now for 40 years. And I think kind of every job I did kind of prepared me more for the future. And when I became Treasury Secretary, I think it was helpful that I had a background in markets and risk. I had a background. I had been CEO of a bank, so that, I understood a lot of these issues. We're small enough that we focus on a handful of investments. We've done about 10 investments to date. And, I find it very interesting.
Okay. You agree with my view that the highest calling of mankind is private equity?
I do not.
You don't think so? There's something more important? Well, I don't know what it is, but okay.
I would have thought you were going to tell me the highest calling was to own a baseball team.
If it's a winning team, yes. But so let me ask you, when you're Secretary of Treasury, and you're a very powerful person, and then when you're on the private sector, you're going and asking people for money who used to ask you for information about what's going on. What is it like to kind of make that switch to kind of asking people for money who used to ask you for not favors but more information or help? Hard?
Well, no. I mean, first of all, fortunately, we're not in the fundraising business, and
you raised for your first fund about $4 billion plus or something.
Well, I can't comment on the size of it and things like that, but yes, we did raise our fund. But what I find interesting now is actually it's when you're Treasury Secretary, and it's an extraordinary experience, but you can't publicly talk about a lot of things, and there's limitations on what you can do. So I find it actually quite interesting being involved in different things now from the outside.
Well, one of the pleasures of being Secretary of the Treasury is you get your handwriting on the dollar bill, something like that. So some Secretary of Treasury had incomprehensible, indecipherable handwritings, and you couldn't figure out who actually was signing it. But what was the pleasure like of getting bills, $100 bills or dollar bills, and having your signature on it? Was that fun or not?
Well, David, I changed my signature because my signature was completely illegible. Okay. Oh. And I thought if I'm going to have my signature on the money forever, it would be nice if you could see it and read it. So I simplified my signature a lot. I guess the question is I wonder if President Trump wants his signature on the money.
By the way, I have a similar problem. I can't do cursive because I think that was being taught in the second grade when it was Jewish holidays, and I wasn't in school, so I can't really write cursive, so I don't have to worry about this. I'm not going to be Secretary of Treasury. But there is a proposal now to have a $250 bill, a bill has been proposed in Congress with President Trump's picture on it. Usually, you're supposed to have passed away before you get your picture on it, but do you have any comment on that? Or?
Well, my only comment is, why would he pick 250? Let's go for 1,000 if they're going to pass the law.
Okay. Well, when you were Treasury Secretary, you did work on, I think, having a woman on the dollar bill. Was it the $20 bill or something? It was going to be somebody, but it took years to get it done. It hasn't happened yet. Do you actually think there will be a woman on the dollar bill in our lifetime?
Well, David, what I was focused on, and I knew it wasn't going to be my decision. It was going to pass over. I don't know if it'll be Scott Bessent's or not. But what we were very focused on the time is the issue around the dollar, and so that you couldn't replicate it and the security features of the dollar. And there are changes that I can't talk about that are in the works around the printing. So that takes time, and that's the most important part of the change.
Now, one of the most important parts of the Treasury code, IRS code, is something called carried interest taxation. You're probably familiar with that.
I've heard about it a few times. I heard about it during the first time.
I know. I talked to you about it maybe a few times. I don't remember exactly. But President Trump has never been a big fan of that, I think you know. And I think in this current speeches he's made about it, he said he wanted to get rid of current carried interest taxation and whatever benefit sports owners gets as well. I don't know exactly what they are. But so do you have a view on carried interest now that you were in the private equity world? Do you think we should preserve it or not preserve it, or you don't want to comment on it?
Well, David, there's going to be a lot of pay-fors have to be in the tax code, and they're going to look at a lot of different things. I will say, first of all, on the carried interest, it doesn't raise a lot of revenue. I mean, look, one of the issues, as you know, on carried interest is if you have two investors, and we invested, if I invested 50% and you invested 50%, we'd each pay a certain amount of tax. To the extent you create a fund and we decide, as opposed to it being 50-50, we're going to exchange profits, it doesn't change the tax that the government collects. So I think from an academic standpoint, there's a reason behind this. From a revenue standpoint, that'll have to be something that Congress looks at.
So what is the biggest pleasure you've gotten out of having a private equity fund now? You raised the fund, you've made a number of investments. Are you enjoying this as much as being Secretary of Treasury or being a partner at Goldman Sachs, or not as much?
I mean, David, all these experiences were really extraordinary. I mean, what I find interesting about this is investing in businesses and being able to impact certain businesses. I've had a long experience in banking. We made a big investment that we bailed out and saved what was Flagstar Bank. It was called New York Community Bank at the time. Yes. And, banking is something that's been very interesting to me. So this is the second time I did this. During the financial crisis, we bought several banks from the FDIC, IndyMac Bank.
Okay, so what are the areas you're focused on? Is it financial services, cyber? What are the areas?
Technology and financial services are two major focus.
Okay, and entertainment, you did a lot of that before you were Secretary of Treasury. Are you doing any of those kind of investments?
We do a little bit of it. I mean, we've been, big investors over time in content. When I was investing in movies, it was more actually a technology play and understanding bandwidth to the home and the demand for content.
Okay, so today, when people invest in private equity, the kind of rates of return they expect are probably lower than they were 20 years ago when more leverage was used and a whole variety of other things. But do you think somebody investing in private equity today with a reputable firm should get a rate of return in the low to mid-teens, something like that?
A little bit higher.
Higher than that?
Yes.
With you, higher than that?
Well, I can't comment on me, but I'd say I would say industry
mid to
returns.
higher teens.
Yes.
Okay. And today, in your view, is Congress likely to deal with the budget deficit in a way where we won't have to deal with the government shutting down? Do you think that's a real risk that the government could shut down again?
Look, I'd say, there's two issues that, again, that I spent a lot of time on, both the debt ceiling and government funding. And, the issue here, and, the government, so as Treasury, we could have the money and not be able to spend it because of government funding. or we could have the government funding but not have enough money because of the debt ceiling. My major focus was the debt ceiling. And one of the things I think now is the most important issue is the Republicans need to get the debt ceiling into a reconciliation bill quickly and raise the debt ceiling.
In 1917, the debt ceiling was first imposed, and we've now raised it more than 90 times. President Trump has said before we should get rid of the debt ceiling, and we're the only country in the world with one other than Denmark. So what is your view on, do we need a debt ceiling because we change it all the time anyway, or should we just keep the debt ceiling?
Well, given the size of the debt that we have today and the focus on the debt, I would keep the debt ceiling. I think it's an important mechanism. It's become too political, but I think spending and the debt ceiling should be passed at the same time. So whenever Congress passes whatever the spending is, they should simultaneously pass the debt ceiling so that you can afford to pay for that. But I don't think, unlimited spending is a good thing. As I mentioned earlier, COVID, we had to do trillion-dollar spending. We then got spending out of control, and we need to get that back into control.
Now, many countries around the world have something called a sovereign wealth fund, and the United States doesn't have that. We have the printing press. We print dollars, and people buy those dollars, but we don't have a sovereign wealth fund. President Trump has signed an executive order, I think, creating a sovereign wealth fund. But where will the money come from for that sovereign wealth fund?
Well, David, as you know, most countries that have sovereign wealth funds are because they have certain resources today that are going to be limited. Right. Obviously, oil and energy is a big focus. And the purpose of the sovereign wealth fund is to capture a huge amount of those revenues today so that it can be spent over generations. The U.S. is not in that situation. So if we're going to have a sovereign wealth fund, I think obviously we'd have to borrow to put the money in the sovereign wealth fund since we don't have a surplus. And if we did that, I think it should be very limited in scope for, are there certain areas that we need government support? It shouldn't be used, obviously, to crowd out private investments.
The third rail of American politics is thought to be the Social Security system and Medicare. Some people say ultimately we are running out of money to fund the Social Security system because people are living longer and so forth, and we have more people retiring and then living longer. Are you worried about the security of the Social Security system?
David, one of the big titles I had in government was managing trustee of the Social Security Trust Fund.
Okay.
And, when I got there, I thought I actually could do a lot of good. And one of the things I was actually very focused on, Social Security still has paper cards. And I thought one of the most ridiculous things is the Social Security number is the identifier most people use. I wanted to focus on creating electronic ID, and I think that's still something we should do. Now, as it relates to the trust fund, we'd issue a report every year. The trust fund is going to run out of money, and I think it's something that Congress has to deal with. I hope that in the second half of the president's term, he can focus on Social Security reform, because it's a problem. The fund is going to run out of money, and there's lots of people who rely upon it, so it needs to be fixed.
In the second half of this term, he might have a different House of Representatives. Historically, the first midterm election, a president usually loses about 25 seats in the House. There's no evidence that what will happen now. But if President Trump were to lose control of the House, do you think that would affect his agenda a great deal in terms of Social Security reform or other things, and therefore he needs to get everything done in the first 2 years that he really wants to get done?
Well, first of all, as you know, the House, we have a very small majority in the House. Right. So, yes, I do think for the first 2 years, he has to focus on what are the most important legislative agendas. Obviously, border security is something he's very focused on. I know there's been this talk of one bill or two bills. Personally, I would do two bills. I think he can have a very quick win on border security and get that done through reconciliation. Tax reform is more complicated, so I think that's going to take a good part of the year. He could get the debt ceiling into the first bill. He can then get all his taxes done in the second bill. I think on something like Social Security, you're going to need bipartisan support. You're not going to want to attack that now. That's something, so it doesn't matter who controls Congress for that. Bismarck, I think it said that there's two things you don't want to see being made are
sausage and legislation. And what is it like when you're doing tax bills? You're sitting in a smoke-filled room, and you're sitting there with the members of Congress, and they saying, I'll give you this, and you give me this. And how does that really work? Is it trade-offs, or everybody says we just have to do what's best for the American people, and we're not going to do any trade-offs or deals?
Well, first of all, there were no smoke-filled rooms. That may have happened in the past, but at least when I was there, nobody was smoking. No, I think that, as I said, we worked very closely with the House and Senate. These are huge, complicated issues. Of course, there have to be trade-offs. You have to think of how there were pay-fors. I mean, when we did this the first time, it was $1.5 trillion static, $1 trillion dynamic, and we had about $500 billion in what we considered to be baseline issues. So, of course, there have to be trade-offs. And then I would just comment on, even once tax reform was passed, we spent the next year writing tax regulations in Treasury, which is a very important function to institute the law.
So if you were king for a day and you can make any change in the way the economy, the finance structure of the United States is based, the spending is done, what would be the one thing you think we should do to make our economy better or make our financial system better than it is today? One thing.
I would reform the spending process and the debt ceiling process so that there was a real process of the administration having a budget, that budget going through Congress every year, and that kind of the focus around spending.
Okay, so for the time being, you're going to be in the private sector. You're not going to be drafted back into government, and you're happy with the highest calling of mankind that you're now pursuing, private equity, right?
The highest calling was serving the people in the government. I know you think this is the highest.
Okay.
And David, I know you've been terrific in advising and helping presidents, and I'm sure you'll also give President Trump a bunch of advice.
Well, I don't know if he needs my advice. Certainly not on the Kennedy Center, probably, but we'll see. Okay. Okay, I think we're out of time. So we're out of time? Right. Okay. Steve, thank you very much.
Thank you.
And that was former U.S. Treasury Secretary Steve Mnuchin speaking with David Rubenstein. Just to bring you some of the highlights here, and there were many. Mnuchin said that he likes the idea of a 10% tariff across the board. He said that he personally thinks Powell has done a very good job at the Fed, that it's pretty clear that the Fed is going to lower interest rates and that the 10-year has already reflected that reality. He also said that PE investors should expect and get a return in the mid to high teens. Really, really interesting interview there. Let's take a look at what markets did while we were listening to Stephen Mnuchin speak. The S&P 500 still pretty quiet. If we bring that up, you can see we're down a little bit right now. The NASDAQ 100 down a little bit more. I will note, Matt Miller, that volume is pretty light today. We saw a big surge in trading volume yesterday, but at least for right now, we're actually a little bit below the 20-day trading.
Yeah, I mean, it may be hard to take a view considering what's happened with tariffs. We've heard Howard Lutnick, well, first, before the tariffs went on, he said maybe it won't be 25%, and then they were 25%. And now, 36 hours later, he's telling people that President Trump may take these tariffs off. Well, that was pretty short-lived.
So,
and I think investors are really having a hard time figuring out exactly what bets to put down. And in that case, I can understand why we'd have low volume. I can't understand if you've got the Commerce Secretary out there signaling that these tariffs are not going to live very long. I can't understand why this market doesn't rally a little bit from the big dents that it's taken the last couple of sessions.
Well, maybe like you said, maybe a wait and see mode. We know that we have jobs data, for example, coming up on Friday. A really difficult environment for traders, but maybe if you have a longer term horizon, you're a little bit happier this morning. You've
been doing such a great job of leading me into the next segment.
We're anchoring together.
I appreciate it. Let's discuss how pension fund managers are approaching the economic and market uncertainty. We're joined by New York City Retirement System CIO Stephen Meier, as well as Anne-Marie Fink of the State of Wisconsin Investment Board here on set at the Bloomberg Invest Conference. Thank you both so much for joining us. It is great, as Katie points out, to get a longer-term view. We're so focused on the day-to-day, but you guys are taking, 5, 10, 20-year views on these things. Stephen, let me start with you. What does your investment horizon look like, and how do you deal with the day-to-day headlines of such a volatile administration?
Well, I'd like to tell you we ignore the headlines, but we truly don't. And we're long-term investors. We've got liabilities that are multi-generational, and we do tend to focus more on 10 and 15-year investment horizons. But we watch and monitor the changes that are going on down in D.C. with the current administration to get a sense for, do we need to rethink our strategic allocation? Are there things that are changing on the horizon that we may need to address more formally in our portfolios?
Well, Anne-Marie, come in on that point. I mean, when you're considering allocating to external managers and the like, how do you factor in what's going on at the headline level?
So we take a barbelled approach, I would say, to it. We do a lot in the privates where we can just kind of ride through the volatility, where we're really looking for 5, 7, 10-year type returns and not worrying so much about the day-to-day. And then at the other end of the barbell, we do allocate money to hedge funds and long-only managers that are much more in the flow every day. And we're seeing, right now, we're seeing there's not a lot of signal in the noise, right? The signal to noise ratio is a little out of whack. And so we're finding people who can really, we're trying to find managers that can really trade around that and take advantage of the swings when there's not a lot of content in them.
Well, you mentioned privates, and this is something I'd like to hear from you both. How do you construct a portfolio with privates? Obviously, private assets have been one of the hottest topics of conversations within these halls and walls. And we heard from Dawn Fitzpatrick, the CIO of Soros, yesterday, saying that actually she thinks private investors are in for a world of hurt when you think about the returns and the liquidity in the public markets. Obviously, Soros is doing something different than the investment objectives you're trying to achieve. But how do you weigh that?
So we're finding that we like privates, again, given the longer term. So our liabilities are a 10 to 15-year duration. So we're thinking about that, that time frame. And then we're just finding that there's a lot of challenges, I would say, in the public markets, right? So you've seen there's a lot fewer public companies now. Given how strong the markets have been, there's been very little IPO activity. And you have David Solomon of Goldman Sachs telling people to not go public. And so for all of those reasons, we do think companies are going to spend a lot longer in the private sector. And we want to go and grab that economic value added through, if it's not going to be in the public markets, we'll grab it in the private markets.
I'd say we focus very much on being strategic and methodical, and I don't think these private markets are markets you can easily or should perhaps lean in and out of. So we want to be a consistent investor. You want to get vintage year diversification. You know, the last couple of years, 2023, 24, have been challenging for private equity. It's been a great time to put money to work. We're able to get better access to the top managers that are in the marketplace, to negotiate better fees, better economics, alongside of co-investments that can give you scale at a much, much reduced price. So for us, we're consistent. I don't disagree that there may be some volatility if you're counting on your private assets to generate liquidity, but we're not. Again, to Anne-Marie's point, we're a 10 to 15-year investment horizon. Most of the deals that we invest in private equity and infrastructure real estate tend to have similar investment horizons.
I would say you're killing it in the public markets anyway, right? But I don't know what kind of portfolio you set up at a pension fund. If you're planning for people's retirement, you have to be incredibly conservative. So how have your assets been doing in terms of returns, and what kind of allocation are you moving into in the private sector, considering the fact that you think this is a buy low time?
So we just had change in legislation in New York State that applies to New York City at the end of 2022, which precipitated a strategic asset allocation review. So we're actually putting money to work. We're going from 25% into alternatives up to 35%. So we're putting money to work when many others are pulling back. So it puts us in a better position to negotiate better terms. But again, 35% at its max in alternative or private assets. We still have 65% in public fixed income, public equity. We have more than enough liquidity. We have 5 different New York City public pension plans that we manage that have different requirements as well. But for the most part, they're all well funded and well allocated and performing well.
So 35% max when it comes
Yes.
to those alternatives. Anne-Marie, what does that look like in your world?
So we're Pretty similar, actually. So we probably about 5 years ago in privates were just under sort of high teens, and today we're right around 30 with a plan to go to 35 over time.
All right, unfortunately, guys, we have to leave it there. Really enjoyed this conversation. That is Anne-Marie Fink of Wisconsin and New York's Steve Meier. Meanwhile, we check on these markets right now. It's been a pretty rocky ride over the past couple days. You take a look right now, pretty quiet. A lot of the action is outside of the benchmark levels. And you can see that under the hood, though, there is quite some movement. General Motors, Ford, and Stellantis all mightily higher after what we heard from Commerce Secretary Howard Lutnick on Bloomberg TV earlier today.
Yeah, this is really another one of the big market moves we're seeing after that Lutnick interview. We will continue to play sound for you from that Lutnick interview throughout the day, but I'm seeing big jumps in GM, Ford, and Stellantis. Earlier today, Bloomberg Television sat down with the secretary to talk with our anchors about whether President Trump might give Canada and Mexico some relief on those tariffs. Let's listen to that right now.
This is not a trade war. This is a drug war. We've got fentanyl still pouring into the country, and it's got to stop. So what's happened is they're showing us even more ways to try to stop the flow of fentanyl. And if they can stop the flow of fentanyl, the president is open-minded. There are going to be tariffs, let's be clear. But what he is thinking about is which sections of the market that can maybe he'll consider giving them relief until we get to, of course, April 2nd. But I don't want anybody to forget, April 2nd is the day that we announce our reciprocal tariffs around the world. And so April 2nd is coming, but this is about fentanyl this month.
Got that. Just want additional clarity. Just to be very clear on this. Yesterday when you said, I think the president's going to figure out, you do more and I'll meet you in the middle, we're probably going to announce that tomorrow, as in today. Can we no longer expect that announcement?
No, I didn't say that. I said the president is listening to the offers from Mexico and Canada. He's thinking about trying to do something in the middle. He's thinking about it. We're talking about it. We're going to, when I leave here, I'm going to go talk about it with him. And I think early this afternoon, we expect to make an announcement. And my thinking is it's going to be somewhere in the middle. So not 100% of all products and not none, somewhere in the middle, because I think Mexico and Canada are trying their best, and let's see where we end up. So I do think somewhere in the middle is a likely outcome.
And that was Commerce Secretary Howard Lutnick speaking on Bloomberg Television earlier today, teasing that we might get maybe a rollback of those tariffs that went into place on Canada, on Mexico, perhaps this afternoon. We'll certainly keep our eyes and ears peeled for that. But let's get back to the Bloomberg Invest main stage right now, because the CEO of TIAA is sitting down with Bloomberg's David
Gura. With inflation and get exposure to markets. So we have been in the business of guaranteed income for over 100 years. And I can tell you that not a day goes by that I hear from either a participant or a family member that says, thank you. My dad is now 90 years old and he's still getting that check. You know, my mother is 80, her husband passed away and she's still able to get that check from TIAA. So the point is that that guaranteed income was an annuity. It was in their retirement plan. And so when I think about where we are today, you're right, there's so many permutations around annuities, so many different flavors. And so we as an industry have to make sure that we can simplify it, or that people are clear on what it is that they have and what it means. So there is work that we are doing. But when I think about annuities within your allocation, it is not complicated. It is, you have exposure to the stock market, you have exposure to bonds, and then you have exposure to insurance. It's simple. It's part of your retirement allocation. It's different than a retail annuity. I think the most important thing is to understand what it is and what it's not. An annuity is not exposure to equities and alpha. Annuities give you longevity protection. It gives you consistency, and it gives you the confidence that you can have income that you won't outlive. And I think that in this environment is so important that we talk more about annuities, make sure people understand it, continue to do our job to simplify it and make sure people are educated around it. But providing access and retirement vehicles is what we've done for over 100 years in the 403B market, and we most recently have rolled it out in the 401k market.
So going back to 1918 and that initial $1 million contribution from Andrew Carnegie to where we are today, the company has grown tremendously, oversees $1.3, $1.4 trillion worth of assets. Can you just talk a bit about that investing strategy you were alluding to just a moment ago? It strikes me as it's kind of very lowercase c conservative. There's not a lot exotic about these main portfolios. Could you just talk about the company's approach to investing?
Well, for us at TIAA and Naveen, we are liability driven. We want to make sure that we are investing in a way that our participants can feel confident that 20, 30, 40, 50 years from now, that the money will be there, it will be well invested, and they will be able to have income that they cannot outlive. And so when we look at what we're doing, we have our general account. We also, with Naveen, have third-party assets. And what's important there is whatever returns that we're getting from Naveen, that ultimately goes back to our participants. We return all of our earnings back to our participants. And so that allows them to get outside performance over time. And so within our company, we serve the 403B market. We've done that. That's a nod to our heritage. We will continue to do that. We see that there's tremendous opportunity to make sure the people that are helping and serving so many millions of Americans, whether it's higher ed and healthcare, can feel comfortable and confident about their retirement plan. But we're also, in partnership with Naveen, taking that benefit into the 401k market so that companies can add insurance into their allocation. And we're very excited about that. And of course, with respect to Naveen and their investment strategy, we do a lot in alternatives. So think about it as 85% of our general account is fixed income, 15% can be alternatives. And so that allows everyday participants through our general account to have access to alternatives, to have access to real estate, infrastructure, farmland, et cetera, PE in a very safe way to generate more alpha for them. But the most important thing is that for us, it is liability driven. We want to make sure that we're investing in a way that will give them the performance and accumulation, but give them the confidence and decum that they will have income that they won't outlive and that we will be there for them.
Going back to the crisis, something that you proposed in an op-ed you wrote a couple weeks ago for the New York Times is more of a public-private partnership, more engagement with policymakers in the face of this crisis. Yeah. Here we are a few weeks into a new administration, a new Congress. How optimistic are you both about the appetite for that by the new president, by that Congress, and the level of engagement that we've seen so far on in retirement issues?
Yeah, the good news is when you're talking about retirement, it doesn't matter if you are in rural America, urban, suburban. It's not a blue state. It's not a red state issue. It absolutely is an American issue that we can all relate to. And so I am optimistic. And the reason why I'm optimistic is that the policy that we have been able to achieve over many years as an industry have been bipartisan. It did not matter who was in office. It did not matter what the ratios were between Democrats and Republicans. It was an issue that everyone came together on. And so I'm looking forward to us continuing to tell the story about how important retirement security is. I'm excited about some of the progress we've made with the Secure Act to make it easier for people to have access to retirement. And so that conversation will continue. We're looking forward to engaging with the new administration and talking about how do we continue to make sure that more Americans can have access to a secure retirement, and how do we make sure that by doing that, that can put less burden on Social Security. By doing that, that puts more money to work so that the caregivers, children are not having to carry that burden. And so I do think that it will continue to be a bipartisan issue, and it is so important. We cannot close this retirement gap without private-public partnership. We have to have good policy. And we have to make sure that we in the private sector are doing our part to educate our employees, to make sure that the plans are designed so that people can have access no matter where they are within their employee base, whether they're senior executives or the people that are on the front line or working in the mailroom, having plans that are designed in a way where you have education, in a way that it has exposure to equities, bonds, and insurance, and having great policy so that more people can have access, to me, is the job to be done. And it is something that has to be done in both private and public sector.
I just want to turn to how you're navigating this moment. And you and I last spoke, it was a few years back during COVID. I did a piece on Black Wall Street and the Tulsa Race Massacre, and I asked you just about the long legacy of that. And we got to talking about DEI, got to talking about how you prioritize that within the company. I think you said it was a cornerstone of what TIAA has done. You, I'm sure, have paid attention to the recent conversation about that. Has it changed notionally the way that your company approaches these issues? What do you make of companies that have, in light of this increased scrutiny, stepped back from some of the commitments they've made before?
Yeah, I mean, I'll speak to it through the lens of TIA and through the lens of me being a CEO. You know, I think that for us, our values are very clear. You know, and our values go back well over 100 years, and that will continue to remain. I've always said that talent is created equally, opportunity is not. And so if the objective is to continue a pursuit towards meritocracy, knowing that we started with exclusionary practices and not having everyone have access to entering corporate America, if the objective is excellence, if the objective is to make sure that we can cast the widest net across our country to attract the very best talent, to develop that talent, and to make sure that that talent stays, then the outcome will continue to be a diverse workforce, because I do believe that talent is there. And so for us, we will absolutely comply with every law, every regulation to the highest standard. And we also realize that there is a need for more talent. We also recognize that there are jobs to be done across our workplace to make sure that everyone feels that they can have access. And when I say everyone, I mean everyone. And so when I think about the opportunity for us, I think the opportunity is to stay focused on our values, to stay focused on making sure that we can cast the widest net across our country, and that when people enter the workplace of TIA, they wear one jersey, that's the TIA jersey, and they're very aligned with our mission. And our mission is to ensure that millions of Americans can have a secure retirement. And I believe that if we stay focused on that, navigate whatever the environment is, always, complying to the highest standard, the outcome of talent will be a diverse workforce.
So just to be clear, when the president says last night with the sweep of a pen, he's ended DEI in government and in the private sector, nothing has changed yet in terms of your
we're
policies.
Always going to understand what the president of the United States is requiring for companies, and we'll comply. But what has not changed is our commitment to talent. What has not changed is making sure that we cast a wider net. And if the president is very much focused on excellence, then we are well positioned at TIA to continue to make sure that we do just that, while making sure that we comply to any standards, any law, and any regulation, and we will absolutely do that.
You're in this kind of rarefied position. I think like the head of CalSTRS is probably in a similar one, where you're able to exert influence on the companies on whom you invest. You can make your opinions known about corporate board composition, for instance. Is that something that you continue to do, continue to prioritize, and does that stand to change with what's happened over these last few weeks?
Yeah, I think, clearly, making sure that we're navigating the environment and what executive actions, executive orders, laws, et cetera. And like I said, we'll make sure we do all of that. But, we're investing in thousands of companies. And it is important for us to understand who the company is, what they're about, what is their philosophy, what is their strategy, understanding their leadership. And so that won't change. If there's things that we have to edit, we'll navigate that. But as an institutional investor, it is very important where we're deploying our participants' money. We want to make sure that we're doing it well and that we understand the companies that we're investing in, so that our portfolio managers can have as much information as they can to make very sound decisions about the overall investment strategy.
You oversee this huge company that has its hand in so many things, and obviously you have to interface with regulators as well. Are you worried about the state of regulation in this country, that you have to interact with them at the state level, the federal level? Do you worry about the cuts that we're seeing in terms of the products that you offer, this broader conversation about what people have when they retire?
Well, the good news is we have a range of solutions, and that hasn't changed. So we haven't seen any impact there in terms of our investment strategy, in terms of what we're here to do. As I think about regulation, I think clearly the president's been clear in wanting to have some deregulation, and that will be a positive thing for companies. But regulation is good. You want to make sure that, we're in a regulated industry. We need to have sound regulation. Clearly, if there's opportunities to improve, the president's been clear about wanting to do that and what that can unleash in terms of companies and their earnings. But I think the most important thing is, one, for us, making sure that we're clear on what we're here to do, which is provide a secure retirement for millions of Americans, understanding the regulatory landscape and whatever laws that gets passed with the president and the new administration, and adhere to that. But never lose sight of the main thing, which is to make sure that we have sound investment practices, making sure we continue to attract the best talent, and make sure that we deliver on our retirees. Whatever the regulatory environment will be, we will navigate that. You know, we've been around for 100 years. We've seen the highs, the lows, and everything in between. But what hasn't changed, regardless of the environment, is delivering for our participants, and that won't change, regardless of any shifts in the overall environment.
So last question, I'm curious how you were thinking about the economy, thinking about markets today. We lived through a lot just in the last 24 hours with the imposition of this trade war. How are you thinking about that?
All right, that was the CEO of TIAA with Bloomberg's David Gura. We got to get her on our show.
Yeah, she was great.
As a guest. She was fantastic.
David Gura was too.
He's okay.
Yeah.
He knows what he's talking about. Host of the Big Take
there you go.
podcast, which I love. You can check out, by the way, all this stuff from the Bloomberg Invest conference on your terminal. You can continue to watch that panel, for example. Just type live go. In the meantime, we've been getting some pretty great headlines from President Trump's trade advisor, Peter Navarro.
Yeah, out with some heat saying that Trump was right. There will be some tariff disturbance. He does say, though, we've had 2 days of volatility in markets, some perspective there. But he also said, this is interesting, when we trade, we have competitors, not allies, a totally different framing, because that has been one of the things we've been remarking on, that these are two of America's allies, Canada and Mexico, not to mention our neighbors. But in Navarro's world, those are...
Yes, and that has historically been the case with Peter Navarro. I think it's interesting that on CNBC, he said he doesn't see Trump wavering on tariffs.
Yeah.
And yet Lutnick has said he's going to pull back. So it's interesting to see this infighting there, or debate. That's all for us today. We'll be back with you tomorrow, same time, same place. This is Bloomberg.